Thanks for your patience as we got prepped for this panel. So good afternoon. I'm John Olson, a CRA officer for Goldman Sachs, welcoming you to this panel on preserving affordability at scale. So we're excited this year to have a panel devoted specifically to preservation. I don't think we need to belabor the point of this panel. I was really struck by what Senator Cardin said to us this morning. He talked about the affordable housing crisis, and he just came out and said we have a shortage problem and that LIHTC does not completely fill the gap. And I was also really struck by what Sean Donovan said. After his decades in the field, you know, he told us that the affordable housing crisis is the worst that he's seen. And it's everywhere. So I think it's clear we need to bring all our tools, all our approaches, all our strategies to the table, and preservation is an important one. And what we have for you today is 3 responses, 3 solutions, 3 strategies, 3 approaches to preserving affordability. So we have wonderful panelists. We have A.J. Jackson from the Washington Housing Initiative Impact Pool. We have Joe Reilly from the Community Development Trust, CDT. And finally, we have Stacie Young from CIC of Chicago, the Community Investment Corporation. So the way we'll proceed is we'll have short presentations from each of our 3 panelists talking about their organizations, their approach to preserving affordability. Then we'll have some time for discussion. We'll talk about just any common themes that are emerging on challenges and solutions and the role of preservation. And then we'll try to leave some time for audience questions. I know everyone's hungry probably. I know we stand between you and lunch, so we'll get to it. We'll try to leave a little time at the end for that. So with that, AJ, I'll turn it over to you to kick us off.
Sure, great, thank you. Good afternoon slash morning. So I'm A.J. Jackson, and Leo Impact Capital, is a platform that owns, operates, and invests in affordable housing. We're a subsidiary of JBG Smith, which is a public real estate investment trust, NYSE listed, that focuses on essentially urban placemaking at scale through ownership of office, multifamily, and retail. And so the first question is, why are we in this business? Why am I talking to you? What we realized, what JBG Smith realized, is that housing affordability is as essential as public education, public safety, and transportation to vibrancy and growth in any community. It's a key factor in corporate relocation and growth and expansion. It's a key factor in the ability of, for example, our retail tenants to operate. So we saw housing affordability as just a fundamental issue in the marketplace and thought about how can we be additive and supportive to trying to address that issue. It also is something that gives us an opportunity to talk to stakeholders, both employees, shareholders, others in the community in a different way when we can lean into trying to address housing affordability. And it's something that we thought with our core competencies in the real estate space, we would be able to be additive to the solution set around housing affordability. As we looked at where we could plug in, we focused really on what we call the missing middle, but essentially folks who are over income for subsidy and under income to afford rent and other necessities like childcare, you know, in a country where the median rent is now above $2,000 and in a place like Washington, D.C. where it's above $2,400. We also focused on the naturally affordable space because we saw there was very little capital organized around it. We saw that it was housing a lot of people, and we saw that on a national level, we're losing more than 100,000 naturally affordable units every year, either to redevelopment or to repositioning in sort of a value add play. And we thought it was a space where we could organize private capital at scale, again, to have a positive impact on that space. We also realized, like with all real estate, and it's especially true when it comes to housing affordability, that location matters. And so I'll get a little bit sort of language geeky for this audience for a second. Our focus is on housing low and moderate income people in exceptional neighborhoods. We don't invest traditionally in low and moderate income neighborhoods. We're investing in low and moderate income households, trying to give them access to opportunity. We think that's a better real estate investment for the capital that we're able to raise. We also think, based on the research of Ross Chetty and others, that it derives better outcomes for our residents, which is a critically important piece of the equation for us. We invest using an impact framework. I won't walk through all the elements, but it's basically designed to drive both results for residents around committed affordability, around economic mobility, et cetera, but also to drive protections for our investors. So everything we do, we think of from a double bottom line mandate. How does it benefit residents? How does it benefit the capital that we're raising? Because again, I think if we want to do preservation at scale, we have to continue to be able to raise private capital to do that. So what did we do? We worked with a local civic group called the Federal City Council, and we created something called the Washington Housing Initiative. There are two main components. The Washington Housing Conservancy is a nonprofit that was sponsored by the Federal City Council. It's focused on NOAA preservation, and it's focused on delivering services to residents. We formed something called the Impact Pool, which is managed by Leo Impact Capital. The Impact Pool takes private capital and invests it in the preservation of NOAA housing. We bring not just capital, but we also bring the real estate expertise and the operating platform, which we think is a crucial element to helping compete in the private market in competition with value-add investors and other private equity for these very same assets. Because when you're buying NOAA, you're typically not doing it through an RFP process. You're typically doing it through a conventional investment sales process in the private market. Just a brief review of how our capital stack looks. So typically, we will provide up to 30% of the capital, 20% in this example, as subordinate debt to a mission-aligned sponsor so they can acquire that property with less equity. Most of our sponsors are nonprofits, and obviously those charitable dollars are the hardest dollars to raise. So we're essentially replacing what would otherwise be private equity with our capital. And then the majority of the capital stack is conventional agency financing, either Fannie Mae or Freddie Mac. So a much simpler capital stack than most of the transactions that a lot of us are involved in who've been around affordable housing for a while, but that's, again, critical because we're competing in the open market for assets. So the Impact Pool, we've raised about $115 million in commitments, started deploying capital in 2020, and since that time have either acquired or invested in 2,800 units. And all of those units, it is a CRA eligible investment because all of those properties have income and rent restrictions. We do income certify residents. We restrict rents in line with affordability guidelines. We do that voluntarily. And so we're taking what was NOAA and making it committed affordable housing. And most of those units are now in the hands of nonprofit owners, so they can be committed affordable housing for the long term. We think that ability to scale quickly, 2,800 units in 3 years, is something that is unique in the space. A lot of you in the room are investors in the Impact Pool, so thank you for that. But really, this slide is one that I love because it shows that this is a collaborative and additive process. We work with other nonprofits. We work with local governments. It's not something that can be done on its own. It's not something that a private sector actor, even one as large as we are, can do by itself. So a simple project example, this is a project in Prince George's County, Maryland, not far from here. This was a privately owned, institutionally marketed 245-unit project that was positioned as a value add. They had started to renovate some of the units and were going to renovate a few more. It was naturally affordable. We partnered with the Washington Housing Conservancy, and they brought in NHT Communities. We gave them about $9 million in financing to help them buy the property behind, again, a GSE first mortgage. And as a result of that, 184 units are now under covenant at 80% of AMI, and 98 plus or minus units are covenanted below 60% of AMI. There's a sustainability plan that's being implemented at the project to bring solar and other energy consumption reduction technology to the property, and resident services are being rolled out there. So that's the kind of thing that we've been able to do using this model. Excited to talk more about it in the Q&A. Thank you.
That's great, thanks, AJ. And then we'll go over to Joe, CTT.
It's not moving, so I don't know what I'm doing.
Can we bring up Joe's slides? Yeah,
there you go. Okay, that's the second one, if you could back up one. Okay, so CDT is a national investor in affordable housing. Many of you know who we are. For those who don't, we're a national investor in affordable housing. We're a double bottom line organization. We just celebrated our 25th anniversary. At this point, our equity portfolio consists of 169 properties, over 20,000 units. We've also got a debt portfolio which supports another 16,000 units in through over 200 loans. The gross value of our assets at this point is about $3.6 billion, and the market net worth of our company is approaching $600 million. Our mission is to provide long-term capital for the preservation of affordable housing. We do that through making long-term loans, as well as making long-term equity investments. And from our perspective, that long-term capital promotes the stability of quality ownership and is good for the residents at the end of the day. That long-term approach is critical to the benefit of the residents at the properties. Okay, let me try this now. Okay, so we are a REIT. 25 years ago, we chose to be a REIT. I'll say candidly, some days I'm happy we're a REIT, and some days I wish we weren't a REIT, but we have been a REIT, we are a REIT, and we will continue to be a REIT. Unless that changes. We're also a member of the Federal Home Loan Bank of New York. We're a CDFI. So as a CDFI, we're able to join the Federal Home Loan Bank, which has a number of benefits for us, but borrowing from them, we've done a substantial amount of borrowing. They're a funding desk for us, and that's helpful to us at this point. We would like them to do a bit more, some different things, and we continue to talk to them about that. And we're making some progress on that. But there's definitely more that we will continue to work with our partners at the Federal Home Loan Bank to do more for the benefit of affordable housing. Next slide, just a quick summary. So I mentioned we've got $3.6 billion in assets. Here's the breakdown. About $3.1 billion is attributable to our equity investments and over $500 million in our loan portfolio. So this year, we closed the largest transaction in our history. It was a joint venture. I think it's important to keep in mind you need to have partners in order to, from our perspective, we need good, mission-oriented, and partners with an alignment of interest. So we did a very large transaction, a total of $1.2 billion. And our partners were the Michaels organization. Many of you know of the Michaels organization, one of the largest and best developers, managers, owners of affordable housing in the United States. We're happy to be working with them. And John and his colleagues at Goldman Sachs contributed in a not insignificant way, I'll say. They wrote a check for $500 million.
I was going to say, you could say the number if you want.
Right, $500 million. Okay. John, that's your personal investment.
Yeah, right.
Okay, okay.
Right. Yeah, $500 million here, $500 million
okay,
there.
all right. And so what it allowed us to do preservation at scale. So in 90 properties, 10,000 units across 8 states. And the impact is on the impact. This transaction could impact over 30,000 residents at those properties. These are tax credit deals. They're closer to the 30-year deadline than the 15-year deadline. So as we know, many of these types of properties, these units are being lost in the world of affordability. And what our goal here is to acquire those types of assets and be in a position where we can give them the best opportunity to remain in the world of affordability. So we need to be patient with the timing of our hold here, how long we hold on to them. And we're optimistic that the vast majority of these units, at the end of the day, will be able to preserve as affordable housing and bring them to extend their affordability for another 30 years. So that's what our goal is. The key things that we've learned so far on this, it's early, first of all. We just closed this in April. It's a lot to absorb for us. It basically doubled the size of our the properties that we've invested in. So it's a lot for us to absorb from an asset management standpoint. And again, it's important that we have good partners. We need Michaels to manage and at some point probably redevelop many of these sites, and we need Goldman to help us with and be patient in terms of getting to that finish line or starting line, whatever you want to call it, the finish line of our investment and probably the starting line of the next phase of life for these properties as quality affordable housing assets. We've learned, of course, and I think there's no surprise in this, that scale requires capital, and a lot. We need a lot of resources to have this type of impact. If we're to replicate this, we need to find, we're happy to have Goldman. I don't know that they want to write another check, how many checks they want to write for $500 million. We hope there will be more, but we need to look for other investors who have that same alignment of interest and a willingness to stay in and be patient while we get to the next stage for these properties. And it's important to keep in mind that closing is day one. So we celebrate the closing. We celebrate that we're now in partnership on 90 properties, over 10,000 units. But that's really just the beginning. It's the beginning. You've got to manage these. You've got to run them. You've got to deal with the challenges that come up on those properties. Again, you need to have good partners to be able to do that. We feel that we've got the right partners in this transaction. And as we look forward, you can only do this if you have the right partners with the right alignment of interests so that we're all on the same page. Things are going to happen. Not everything is going to be perfect as we go through this. So you've got to be able to work through those challenges. We feel pretty confident that we've got the right partners for this transaction, and to do more of them, we'll have to feel the same about our partners as we go forward.
That's great. Thanks, Joe. And Stacie, over to you.
Great. This one's not working for me either here. So for those of you who are wondering about scale, and you're as agog as I am going after Joe Reilly, talking about a 10,000 unit deal, and you're maybe, I don't know, pondering some, I don't know, inadequacy feelings, I'm here for you. Buzz was kind enough to invite me to be on the panel here. We're talking about scale. I'm going to talk about some different kinds of scale, maybe a lots of littles kind of approach. So Community Investment Corporation, CIC, we're a nonprofit CDFI lender in Chicago. We're also a member of the FHLB. And we're delighted to be here today to talk about some of our programs and how we think about scale. Our primary work is financing acquisition and rehab to preserve affordable rental housing. Typically, our work is in historically disinvested neighborhoods. Typically, we are financing small to mid-sized neighborhood owner-operators. Over half of our borrowers are led by people of color. We've been doing this for about 50 years. So when you think about the types of folks that we're lending to, these are guys, maybe they have, maybe they were the maintenance person in a building for a while and they saved a lot of money and now they want to buy their first 6 flat. Maybe they're just doing a few 2 flats as developments and they want to move up a little bit. So these are the kinds of folks that we are financing. We believe that the impact that we have is not just in preserving a lot of affordable rental housing in the neighborhoods, but also really building these are entrepreneurs. These are small businesses. We don't normally think about landlords as small businesses, but that's who they are. And so by providing access to capital for these folks, helping them out, maybe we're providing the first loan, maybe we're providing the 50th loan. We're very hands-on. We've got servicing in-house. We do a lot of things in-house. We have property management training. So part of our impact is also cultivating and building these small businesses. And in the case of our small local BIPOC developers, we are growing generational wealth. So we see kind of a few different bottom lines. I forget how many bottom lines you have, Joe, but we have a few too. It's hard to keep up. So what we do, this is very much like AG was talking about. So people talk about lasagna financing and lots of sources of capital on those tax credit deals. We're more like buttered toast financing. And so we provide 80% of the deal in first mortgage financing, and then the borrower brings 20% to the deal, very simple. Again, just plain vanilla kinds of deals. The types of buildings that we're financing, think about a 6-flat on up to 50 units. Hey, we'll finance anything, but that's our typical scale is a little bit on the smaller side. A group of banks got together to create us 50 years ago because they knew that there needed to be access to capital in these historically disinvested neighborhoods to keep Chicago strong. They knew that. They didn't want to go it alone. They knew that these smaller buildings were less likely to get financing from the larger lenders. So they created us so that we could be experts in the market, experts with these developers, and experts on the housing stock. So, so when we think about scale, and you think about a 6-flat, naturally occurring affordable housing, this is what it looks like. 70% of the affordable rental across the country does not have subsidy associated with it. 70% of the affordable rental. And so that's what naturally occurring affordable housing is. It's affordable because of the low values in those markets. So the values are lower and the rents are lower. So when I'm talking about scale today, I'm talking about scale as it relates to NAAHL. This is a predominant housing stock in these lower cost markets. In Chicago, these historically disinvested neighborhoods, they're all over the place. And there's a real scale there that needs to be addressed. I'm also talking about the scale of these small neighborhood developers. There's a lot of them. A lot of them want to be developers. A lot of them are. A lot of them need to grow. And there's some scale there that we need to think about and we need to address. The other scale that I'm going to talk about today is in programs. So there are many programs that we have put in place in order to address the diversity of challenges to preserve this affordable housing, different kinds of affordable housing, in different kinds of markets with different kinds of developers. Now, lucky for you, I only have 10 slides on each of these programs, so I'll be able to get through pretty quick. No, so I'm just going to give some highlights here. The idea is that a lot of programs leads to some scale. And we don't even have some things listed up here. What do you think of that? But the big one here is our multifamily lending program. This is the core of our work. And we've got a $330 million pool. We've got about 50 lenders who have committed to that pool. Thank you to all of our investors here today. If you don't know anything about it and like to learn more, I'm here all night. I'd be happy to talk more. But that's the core of our work, and it's that plain vanilla multifamily financing that I just mentioned. I'll just talk about buckets for these other programs. So we've got some programs that are really targeted to specific neighborhoods and geographies. So for instance, when you see that mezzanine debt program, when you see the Woodlawn Construction Loan Fund, those are low-cost financing programs that we provide in exchange for portions of affordability. Now that's a different kind of program than our typical multifamily lending program. For that program, we don't have any affordability restrictions. But when we're providing some kind of low-cost financing, when we're providing a subsidy, there is always an affordability restriction attached to that. So there's some geographies that we're targeting for different things. Those two that I just mentioned, those are higher cost markets. So we're trying to incentivize affordability, and we get there with that lower cost financing and a affordability restriction. We also have some programs targeted to different kinds of stock. You see 1 to 4s sprinkled throughout there. We didn't do any 1 to 4s prior to the 2009 recession. We do them now in different ways. We also have a program that's not up there. We worked very closely with some community groups on a very specific housing type called single room occupancy. These are SROs. Losing a lot of them in Chicago for a lot of different reasons. They're not in good shape. They're in stronger markets. And so we asked the city of Chicago to say, look, these community groups really want to preserve this housing. Let's figure out a way to do it together, really based on the market and these owners that we typically work with. I'd be happy to talk more, but we had structured that in a very specific way in order to allow that government financing to be deployed efficiently in a streamlined way to these private owner developers. It's difficult to use government money, and I'll leave that as a question later. And then the other kinds of programs listed here are programs that we actually don't finance. These aren't financing pieces that we do. They're programmatic. These are government partnerships. We have a partnership with the City of Chicago called the Troubled Buildings Initiative. We love and support our responsible private developers, but if you don't take care of your building, you better watch out, because we're coming after you. The city's gonna come after you with building code enforcement, and they might talk to the court to appoint us as receiver. And then those actual repairs get made by us, and we get paid back via a priority lien. That's a wonderful program that produces a lot of preservation units. And we have some other policy collaborative work that we do with lots of different government agencies to preserve existing government-assisted housing. And on that policy side, we also have an interesting piece that we've done that's, again, not here, but we worked with lots and lots of diversity of partners to create a property tax incentive in the state of Illinois, and that's producing a lot of affordability as a result. You invest in your property, you keep some units affordable, you get a property tax break. The things that aren't on here, a couple of things that are actually targeted to developers. So we started a $5 million pilot equity fund. We're investing equity alongside BIPOC developers. We've never done that before. My heart palpitates as I talk about it right now. But we're using a portion of our Mackenzie Scott. We got a nice Mackenzie Scott grant. We took $5 million of that. We're targeting developers with that. We also have an energy program. We do a lot of energy efficiency financing. We created a new energy and climate sustainability program last year. And we have a special neat little program we're doing with Chase to really target BIPOC developers to really help them build capacity to get ready for all the climate stuff you just heard about on the last panel. So we've got a lot of littles to get to scale, and I look forward to a lot of great questions from John.
That's great, and others, yeah. So this is a fascinating group, and we've got three different approaches and three kind of different settings, different types of neighborhoods, different types of developers to work with. So we have tons to dig into. But I wanted to start with maybe a couple of kind of contextual questions. And one is about preservation. I would love to hear how you all think preservation fits into the broader affordable housing conversation. Do you feel like preservation has its seat at the table? Or do you sometimes feel like you have to wave your arms a little bit and say, hey, preservation's important too? Where does preservation fit in here? AJ, let's start with you.
Sure. I think it's starting to get a seat, although more so on the LIHTC preservation than on the NOAA preservation. You know, I ran around for a lot of time. Basically, we're talking about production, and production is essential. But if you're leaking sand out of the bottom of the sack, then putting more in the top doesn't actually solve the problem. You have to cinch the bottom and fill the sack, right? And I think that's starting to be accepted, but I think there's still I think in some circles there is still some belief that, well, NOAA preservation, is that really doing anything? And so we've had to sort of dig into data and show, look, we're losing those units. To Stacie's point, most affordable housing is not subsidized. It is NOAA, and we're losing those units. And there are links between loss of NOAA housing and much worse outcomes for people with much lower incomes, including increased homelessness. And so it's starting to get some traction, but I think we've still got a ways to go.
Some more work to do. And Joe, do you?
So I always start with people. And the people who live in the units that we just acquired, I think preservation is pretty important to them. Yeah. This is their home, right? I mean, we spend a lot of time talking about the economics of deals and transactions, and we think about this from a real estate perspective, and yeah, we need to do that. But we should never lose sight of the fact that there are 30,000 people who live in those properties. And the stability of their homes is very important to them. So if it's important to them, it should be important to us to try and figure out how to do that. And I don't think we can be perfect in this. We acquired 10,000 units with our partners, and listen, we can't do this without our partners, but I think that as long as there's an alignment of interest there, and the focus is on making sure that we maintain those homes for those individuals, the people, the residents of those properties, then we got to say this is pretty important. I mean, you're stabilizing the life of a kid who's going to school. So many of these properties are being lost left and right because they're valuable real estate assets, right? So, and they're worth more if you raise the rents. So what we're trying to do is trying to find a way to help preserve those units, but also preserve the homes of those individuals, which promotes the stability of family, of kids going to schools, kids, families and their surroundings and their local institutions and churches and things that are important to them, as opposed to disrupting all of that. So I think that preservation, it's pretty important and is something that we're going to look at very closely as we go forward. And we think about, well, how are we going to do more of this? Because those units the 10,000 units that we purchased, that we, in partnership with our partners, and I really need to emphasize that, many of them could be lost. And those kids going to those schools, all right, you got to pack up, you lose your friends, you lose your teachers, you got to go someplace else. That disruption is not good, and it's not good for those families. So I think of it from the perspective of people who live there, and I can't help but come to the conclusion that this is a pretty important thing to do.
Yeah, that's a great. I love that frame. That as we talk about units and financing and partnerships and policies and subsidies, at the end of the day, this is somebody's home. Like there's human beings and families living in these homes, and our shared work is to help those families thrive in every sense.
There's a lot of real estate deals out there that we can work on. I like to, and these are real estate deals, but I think it's very important to keep in mind the primary objective here is the stability of home for the residents of those properties.
Yeah, that's great. So Stacie, what about you? Do you feel like preservation has its seat at the table, or is it part of the ongoing dialogue?
Well, I do think one of the challenges is it's not super glamorous. It's a grind. There aren't a lot of ribbon cuttings in front of our Six Flats, I must say. I mean, I do them, but no one comes. And so, it's not getting a lot of attention. But I do think it's getting more attention. And I think that, trying to get the attention of the government, I think what Joe said is right. It's not about the buildings, it's about the people who live in the buildings. This is where folks live. And it's incredibly efficient for us to preserve a unit, to finance, all in, we're looking at, for acquisition plus rehab, $60,000, $90,000 a door in Chicago in disinvested markets. But for us to lose those buildings and then replace them with, a tax credit new construction deal, which I'm all for, but golly, we better preserve what we have because it's awfully expensive to build new. So we have to be efficient in thinking about that. And then, we have to advocate for resources. We have to advocate for the families who do live in those buildings so that they stay maintained and affordable as possible.
Yeah, Joe, you want to jump?
Just add one thing. I think that, it's nice to look at a 10,000 unit transaction, but I think that the residents of the properties that you work with, their home is just as important as any one of the 10,000 families that may be positively benefited from our transaction. I think that it still comes back to people, and there are different types of properties, there are different needs of properties, and the preservation of 6 units to those 6 families, that's just as important to them as the preservation of doing this on a larger scale. I think that there's a place for all of that. I think that we need to do all of it, and I don't think we should at all dismiss the work done to preserve a small building versus that of a big building. They're people. People live in there.
Yeah, that's great. So another kind of contextual question maybe. This work sounds hard, even under the best of circumstances, but following on the theme we picked up in the CDFI leader panel, interest rates are rising, rents are rising, costs are going up. We talked about insurance costs on that panel. So I'd love to touch on just the environment and what those challenges on interest rates and costs are doing to your business model and the challenges in this current event. So maybe we'll go the opposite way. So Stacie, do you want to kick us off on that one?
Yeah, I mean, I do think that variety of programs that I walk through, it's a counter-cyclical strategy, right? So we had a lot less volume last year on that big multifamily pool that I was describing. but we were able to backfill a bit with those other programs. So I think, having, different offerings, working with our partners, and to make sure that we do have the right offerings priced right. But I also think this is a very scary time, and I've heard a lot of people here talk about this over the past few months, but asset management has never been, this is a scary time. So we see that our delinquencies, they're going up a little bit. It's not, we're not super alarmed, but I think this is happening to everybody. We need to keep an eye on, we have to be in constant communication with our borrowers. On that troubled building side, we have been appointed receiver on a 1,000-unit permanent supportive housing portfolio. We didn't finance it. This is that other piece that we're, partners with the city of Chicago, but something went wrong there. And we have to pay a lot of attention to asset management. And, there's loans are maturing, you're coming up to your adjustable rate. So this is a critical, forget about new business. Let's make sure that the portfolios are strong and we're in close contact with all of our borrowers.
Yeah. Joe, what about you, the current environment?
Well, I think it's a time to be concerned. All right. I think that we're fortunate on the large transaction that we've got long-term fixed rate financing, so we have some time there. But insurance costs are out of control, right? So you look at operating these things; they tend to operate on pretty thin margins to begin with, and now we're going to squeeze it more with higher insurance across the board. Insurance numbers are higher everywhere you go. And from my perspective, I don't think this is part of a wave, and we're just going to wait for this to pass. I think that we're at a point where that this is just the new normal, and we're going to adjust to that, which means there are going to be adjustments to values, and there's going to be a number of some time that has to pass in order for the dust to settle on this. But I think it's a time to be concerned because. Okay, I'll say we're fortunate we have fixed rate financing. If we didn't, then you've got this sort of perfect storm of let's refinance at higher rates at the same time as insurance is skyrocketing. This is a problem, and it's a real problem that we're going to have to deal with. We'll figure it out.
So I'd agree with Joe on the insurance issue, and I know there's been a lot of discussion about that, but I think for our business of NOAA preservation, I think about who we compete with, the move from a speculator's market to an operator's market is a benefit to us, right? I think that is creating opportunity for us to do increased preservation. Most of the assets that we compete for that we don't win go to value-add investors with syndicated equity and short-term floating rate debt. And a lot of that debt is maturing. A lot of that equity is difficult to raise. And so we're starting to see those transactions come back to the market, those assets come back to the market. And so we think that is an opportunity. At the same time, I agree, you have to be very cognizant about what's going on with insurance, and asset management is really the name of the game right now across the board. I think, like Stacie, we think a lot about really on a almost biweekly basis, looking at what's going on at the individual property level, what's going on with residents, because we're concerned that if the economy starts to soften further, that's where we'll see the first signs of stresses with those residents. So how do we maintain those people in the assets? But big picture, I think this move could be beneficial to preservation.
Yeah, it's interesting. It presents an opportunity as well. Yeah, Joe.
I think that we should be very concerned about how much short-term floating rate financing is out there in the world of affordable housing. This is not good for the residents at the end of the day. We've seen it time and time again that owners want short-term financing because maybe the rate's a little bit lower today and I get more cash flow this year, but the instability for that property over a period of time is just not a good thing.
That'll come home to roost at some point.
It's not good for the residents at the end of the day. We've seen it time and time again, and we're at a point where the reset of interest rates on so many properties at this point is going to be a problem. Combine that with insurance spikes, it's a time to be concerned about that. Again, we've all been doing this for a long time. We'll figure it out.
And what does that figuring it out look like? I mean, if we see this coming and we know there's perhaps something of a reset coming, are there things you can be doing or we can be doing as we see that coming?
I think that part of it could be, we'll continue to hope that there is more subsidy to bridge that gap to some extent. I think that we're going to have to look at that insurance policies may change. We may be looking at higher deductibles and figuring out ways to insure against catastrophic loss as opposed to every little thing that happens. And I think that we're going to just have to deal with that, and that's part of the new normal. And we've always got to be focused on efficiency and all of the things that we talked about in the last panel of being more energy efficient. Any way that you can find a way to make a property more efficient, we're going to have to figure that out. And I'll say that in my experience in the field of affordable housing, as long as I've been involved in this for 45 years, I think we've always been focused on energy efficiency, right? Since I was doing Article 8A loans at HPD in New York City, we were changing the windows, the boiler, the roofs to make a property more efficient. So we're actually, in this field is pretty good at being focused on energy efficiency, and more resources will allow us to do even more of that. So we're going to have to be focused on that and managing more efficiently. Hopefully there's a bit more subsidy that comes to help us get there.
Yeah, that's great. Well, maybe that's a good segue to a different topic. I kept hearing about partners, like, right, that the word partner may have been the most frequently used word as you all were presenting. And I want to think in particular about operating partners. I mean, at the end of the day, you have a piece of real estate that needs to operate and be managed and be run. So can you all touch on, we'll start with you, AJ, can you all touch on how do you make these properties function and that kind of property management and operating oversight?
We're very fortunate that we can leverage the operating platform, right, of a large public company. And that was one of the things, I think, frankly, that when we started this initiative that we underestimated, and that's ended up being critically important, as equal to, I would say, the capital and the structuring of the capital that we can provide. The NOAH space, the workforce housing space, is a slightly different space for a lot of our nonprofit partners than where they're used to operating. And the ability to operate properties that have both a compliance component and also a marketing component is something that we've been able to help with and sort of lean into from a platform perspective. So I think that's really where we've been fortunate. We have some very, very high capacity groups, particularly in this region, but it's just a different business, right? And so I think that's been something that we've learned. And then obviously the local public sectors across the various cities and counties have been tremendous partners as we've gotten more traction around to the earlier question around the notion of NOAH preservation, their willingness and ability to support that work, particularly through local property tax abatement has been really essential to closing gaps in some of those deals.
That's great. So Joe, can you talk about, 10,000 units is a lot of units. So can you talk about that approach and that structure of just operating these properties?
Choose your partners wisely. I think that you make sure that, Michael's is an organization that has capacity, and they've got the systems in place. So I won't say, and I won't speak on their behalf, that we can just absorb another 10,000. It's still a thing to do, right? So and there's a limit to what the capacity is going to be for any organization. So I think we've got to be very, as we invest in this, we've got to be very cautious about making sure that there is adequate capacity and that we're not pushing them too far. There's a phrase that one of our board members has always used. Nick Ratsinas has used this phrase that more organizations have died from indigestion than starvation, right? And when you think about this, if you take on too much, it's just it can be a problem. So we have to be cautious about how much we expect those partners to do. Just because they were able to do this much, can they really take on that much more? And 10,000 units, it doesn't matter how big your organization is, that's a thing. And that's a thing to do. So we've got to be careful about that, making sure that we don't try to push organizations too far. And then they die under their own weight. They've just taken on too much, because it's hard to say no to the opportunity sometimes. So you take on the opportunity, and then afterwards you realize this was really too much. You got to try and make that assessment up front as best we can.
Right, forcing scale doesn't.
You can't force it. It's got to, the capacity has to be there. And that's going to be a limiting factor at some point in terms of how much affordable housing we can do, but how much preservation we can do.
Yeah. So Stacie, you're in a much different context where you don't have like an operating partner. Like you've got all these developers and owners that you were describing. So how do you approach that of overseeing these properties one by one?
I'm just a little bit stuck on dying from indigestion. I'm sorry. Give me a minute. So all of our borrowers are partners. So thank you. Yeah. And you know, it's interesting because we do have over the years these different programs. And I didn't dig into every single piece of this, but we have a little bit of a continuum of working with folks at different sizes. And thinking about, you know, like supporting them at different phases. So we've got property management training, you know, the scared straight for developer training, you know, making sure that they know what they're getting into and making sure if they're already developers, they know the resources, they know best practices, they're up on all the greatest stuff. So we also have an acquisition program that we do on 1 to 4s, and we actually buy 1 to 4 unit buildings, and we assemble them, and then small developers can buy them from us. So this takes a lot of the transaction costs off the table. And they can figure out, you know, if this is the business for them. And some of them are now our partners on this equity pool that I mentioned to you. I mean partners. Did I mention that? So we're like limited partners in these deals. This is very different for us. But truly, we're very careful. And some of them are very small, and some of them are medium sized, but they need a little more access to equity to make things happen. But the vetting is just nonstop, right? Because if they don't have a good track record, if their properties aren't looking good right now, what's to say? You know, why would these properties look good that we're financing now? So our partners are very important, and we try to support them on many levels on the policy side. We are bringing them together. The city of Chicago says, CIC, what do your folks think? Thankfully, the city is a great partner right now. They understand that the small owners are implicated for all these policies they have. So we bring our folks together and ask them about that, and they give feedback on that. So our partners, it's sort of, you know, all over the place. Like we want to support them, but they're supporting us, and they're supporting good policy. And, you know, along the way, maybe they're growing. Maybe they're good with 1/6 flat. But we're keeping up with what their needs are, and they're letting us know, you know, if we're doing a good job, and we can realign as we go.
Yeah. I think that Stacie and Joe made me think of something that one of our founding principles early on was, let's not create or do anything that we can copy or steal or borrow, right? And so this idea of knowing what you're good at and where your skills are, what's needed, and then going out and trying to find it was really, really important. That goes back to this issue of partnership, right? We have always tried to partner as much as possible so that we can stick in our lane where we think we can both add the most value, but also take the most risk out of this business.
Yeah, that's great. We just have we could probably go on for another hour, but I know people are hungry. So we're going to pause here and see if maybe there are audience questions for our panel. I think there's a microphone coming around. Any questions for? Yeah, Reza. Can you wait for the microphone? Yeah, it's coming right away.
Thank you. Great presentation. Thanks very much, everyone. Joe, I guess the question for you, so you got this 10,000 properties, you're going to go through rehabbing some of them, and reflecting on the earlier panel about energy efficiency. Do you guys have plans to build that into any of those rehabs? Is that a component of the broader program?
Absolutely. And as I said, as long as I've been involved in affordable housing finance, or from the time I was an organizer, we fought for more access to funding from the city of New York to replace windows, boilers, and roofs, because that's what would improve the efficiency of the property, which would put less less pressure than on the rest of the expenses so that the property could be properly maintained. So the answer is absolutely, positively, yes, we will use whatever resources available to try and improve the energy efficiency of properties. And I'll say again, I think that our world of affordable housing, I think we've always been doing that.
Great, so maybe time for one more, yeah, Kirsten here.
You probably don't have an answer to this, but I wanted to ask, the insurance crisis has been mentioned a couple times, Sean Donovan, I think, and others, and you on this panel. What is a solution for that problem for our multifamily and our single-family properties that are facing these rising insurance costs? What can we do?
So my first answer is, I don't know. But I think that I think you can look at, I think you can look at a lot of it at this point as that it's climate related, that there are more, it's not even, we've had catastrophic events over the past few years, but we're having more small ones here and there and there and there. And that's why I think this is part of the new normal. So, okay, it'd be nice if we solved the climate crisis, I suppose, but I think that I don't know that I'm concerned about this because, I'm concerned for our residents, the impact on our residents. I'm concerned about the viability of the properties. I think it's here to stay. That may be a little bit too negative, but maybe there'll be some settlement in it at some point. But I don't think that we should anticipate that this is a wave. I think that we're in a different place. There are properties that we have where they will just say no. And somebody mentioned it earlier. We're back to the world of redlining. We're not providing. We're not going to that neighborhood, and so we've got a property with no insurance. And then finally they'll say, all right, we'll give it to you for this, which is some ridiculous number, and you have no choice but to take it. Okay, you take it now, and then you have to look at, from a value perspective, there's going to be a negative impact on the value of the property over a period of time. I don't have a perfect solution to this. I think it's a real problem, and I think it's going to be here for a while. And maybe we need to find other ways to cut expenses. Maybe it's the energy efficiency, the side of things that we have to do in order to offset the spike in insurance. I don't know. We're going to keep working on it, and I think that we need to remain optimistic that we'll figure it out. If not for that, I don't know what we do.
Yeah. And maybe, Stacie, Deja, maybe we can just quickly hear how you all are responding to this rising insurance cost.
Oh, no, I mean, I'm going to go darker than Joe. Sorry about that. But
I didn't think that was possible.
Talk about indigestion. God.
I think the racial discrimination element here is horrifying. And, so Sean Donovan mentioned this earlier, because to me that's different. It's, the climate piece is horrible. And, I don't know what the solutions are there, but I tell you what, when someone's asking if you have HCVs in your building, that's a problem, actually. I read a report that said, the insurance agent was asking, so what are they playing outside your building? Hockey or basketball? And, this is nuts, right? And right now there's insurance agents who are not insuring our clients because they say they haven't fixed building code violations. Well, guess what? The city of Chicago hasn't updated their building code violation database since the beginning of time. So it's not just the folks in the historically disinvested neighborhoods who should be dinged on that. It's everyone, and not everyone is getting dinged. So to me, let's start there.
I think that's a good point. We have. I think we have one property that the insurance company says, we're not going there. We're not insuring in that neighborhood. Okay, that's redlining. Yeah. So are we back to where, right? I mean, we're seeing the same kinds of effects now. And yes, it is generated that way. They'll ask little questions here and there to try and figure out who lives in that property. And then they'll connect the dots to what they, I think you're right, Stacie, is that's an issue as well.
Man, horrifying is the right
There's a combination of things here. And listen, I think that they're losing a lot of money. So they're trying to find ways to do this. They're not necessarily doing it, quote, the right way.
Yep. So AJ, I know we're close on time, but did you want to add anything on the insurance piece before we close?
I would just say, we've had some success with a captive insurer, and I think that to Joe's point, you break down the climate piece and then everything else, right? And I think there is a real mispricing of risk, and there is some bias there, and captive may be a way to to address some of that. And I wonder if there is a structure. I don't know if there's a structure that's like CDFIs, that's like a more of a collective structure of insurance to allow for the industry to allow to fill some of that gap.
Interesting
One last
strategy.
thing is, buying insurance in bulk is cheaper than doing the individual transaction. From our perspective, we've got quite a few different partners. It becomes challenging. Maybe over time, you have to look at ways to be able to buy things in bulk, which tend to be more cost effective.
That's a good strategy for someone to be thinking about. So good. So please join me in thanking our panelists. Very good. And Buzz, if
you have been so good, we're going to feed you. There's going to be food right over here as the divider parts, and also we're going to have food out just behind the room, so you don't all have to get in the same line. But here's the deal. At 2 o'clock, we're going to have Michael Barr, Marty Gruenberg, and Mike Sue here to talk about the new CRA rule. You don't want to be late for it. Thanks.